41 super investors are investing in these 5 media companies, including the very best Seth Klarman and Warren Buffett. Today, starting with Warner Brothers Discovery, we will explore why so many super investors are excited about media companies these days. Let's start with the overall industry analysis. The main way media companies create value is through content creation. These companies not only create various news, documentaries, and TV series, but also have rights to broadcast sports games. And another important category is movies. A recent trend in movie industry is utilization of franchises like Disney's Marvel series shown here, or Star Wars and Star Trek are also good examples. And such franchises increase media companies' profitability as they increase success rate of new movies, and also these stories go beyond movies to TV series or games. And such wide range of contents reach the end consumers through the middlemen, who pass on the contents and collect fees from consumers. For example, in the past, when a movie is created, it's first premiered in movie theaters, and then DVDs are sold and are shown on cable TVs. And of course, nowadays, streaming services like Netflix also play an important role as a middleman. Media companies get paid through the ticket or subscription fees that consumers pay through the middleman or through the ad revenue shares. And in terms of the cost, the most important item for media companies are creating contents. But an interesting aspect here is that media companies don't have to create all the franchises themselves. For example, Disney now owns Star Wars franchise, but Star Wars was originally created by Lucasfilm, and Disney only bought the franchise in 2012. Purchasing such popular franchise can be expensive, so only the largest media companies that have global scale can make profit out of such deals. And so the economies of scale is an important competitive advantage. On the related note, now let's move on to the bull versus bear on Warner Brothers Discovery, with ticker symbol WBD. The first reason why bulls love this stock is that it's a spin-off. Warner Brothers used to be part of AT&T, but became an independent company in 2022. And this is a positive because according to Joel Greenblatt, the legendary value investor, there are 3 reasons why spin-offs tend to outperform the market. Let's start with the first reason. A lot of AT&T shareholders invested in it because it's a high dividend paying stock, and these shareholders received the spun-off WBD shares. But because this new company does not pay dividend, the existing shareholders will sell the new stock, not caring the price. This is one of the reasons why WBD stock price fell about 60% in only about 6 months since its launch. The overall market also fell during the time, which didn't help WBD neither. Moving on to the second reason, the management team who took over WBD has a strong incentive to realize significant accounting losses in the beginning. Because after all the bad news are out, right after the spin-off, the management isn't responsible for the past errors. And it gets easier to show improving performance to shareholders afterwards. Warner Brothers followed this exact pattern by dropping $2.5 billion of restructuring costs and write-offs in just 2 months. Now, lastly, on the outset, the fact that the newly created company has $53 billion of debt burden, which is 107% of debt-to-equity ratio, looks negative. However, Greenblatt points out that as long as the company can generate stable cash flow to pay down the debt, such spin-off creates an LBO-like high return to public shareholders, thanks to the leverage effect. The key here is whether the company will generate enough free cash flow. So now, let's move on to the second bull thesis, which claims that the media companies now have stronger market power that will help them generate more cash flow. About 50 years ago, when cable TV was rising in the US, there were dozens of small and medium-sized media companies competing against each other. But throughout several decades of continuous M&A, only a handful of large media companies came to dominate the market. So this 2012 Business Insider article worries that the 6 largest companies control 90% of the media in America. For example, in 2010, these 6 companies' movie revenue was double the movie revenues of the next 140 smaller studios combined. If so, what happened to these 6 largest companies since this article was written 10 years ago? Well, in 2019, Disney acquired 21st Century Fox, and in the same year, Viacom merged with CBS, and became Paramount. And this year, Warner Brothers merged with Discovery to form WBD. So overall, the 50 media companies that held 90% market share 50 years ago became the top 6 10 years ago. And now, it's the top 4 that has so much power. Because the largest mergers took place in the past 3 years, the resulting power could translate to strong free cash flow soon. The third bull thesis relates to the middleman of the industry. While the media companies in the left strengthened its power, the middleman had an opposite effect through technological changes. In the past, these three methods dominated the middle, but internet has changed all that. In addition to these traditional channels, now other internet-connected devices, such as PC, smartphones, and gaming consoles, can all stream high-quality videos. This means even more power to the media companies because they have more players to negotiate with. This picture was not always obvious. For example, when Netflix came out and grew really fast, the industry worried that Netflix will dominate the whole middle ground, which would have weakened media companies' pricing power significantly. However, competing services such as Amazon Prime, Apple TV, and Hulu gained ground, and Netflix's dream scenario seems unlikely every day. And perhaps such losing ground is reflected in its lagging stock price recently. All these changes are good for the media companies, but the most important change is actually DTC, or direct-to-consumer streaming services run by the media companies themselves. DTC completely passes the middleman and reaches consumers directly, and obviously no middleman means more profit for the media companies. Such DTC streaming is only possible nowadays thanks to the large cloud companies that laid out the necessary cloud infrastructure all over the world. Moving on to the bear thesis on WBD, the first actually relates to the company's DTC streaming service called HBO Max. Launched in 2020, it now has 95 subscribers, which is quite large, but still small compared to the Netflix's 220 million subscribers. And in order to grow, the company is still pushing hard on marketing cost, which is creating even larger loss at the segment. So the worry about HBO Max's profitability is one of the key bear theses. Bears also claim that the new middlemen, such as Amazon Prime and Apple TV, have ambiguous roles. For example, Apple TV is creating popular original series, which compete against the media companies' content. And so in this perspective, media companies may have to face larger big tech competitors. Lastly, as mentioned previously, advertisement is an important revenue source for the media companies. So as economic downturn starts, ad revenue could suffer. This is a short-term thinking, but it raises a good point that media companies may face some headwinds in the next few quarters. And in order to make profit despite such short-term headwinds, we have to make sure that WBD has a large margin of safety in current price. But when valuing this stock, we have to consider that this company was formed just a few months ago, so we don't have years of detailed data to analyze. So I based the valuation on separate EBITDA number from each entity and created 3 scenarios. The first is that the earnings will go back to the pre-COVID average, in which case it will have about $10 billion of free cash flow per year. The second scenario uses the recent 2-year average result and assumes that WBD's earnings will remain low forever. And the third scenario uses management's $3 billion cost synergy expectations starting next year. This is also realistic because in the most recent third quarter earnings call, the management team felt confident enough to actually raise the target to $3.5 billion. Also, in order to reflect the last bear thesis that economic downturn will lower ad revenue in the next year or two, I lowered free cash flow by about 80% for the next 2 years. And even after that, free cash flow will go back to the normal level only 5 years later, after which it will stay stagnant. And based on these conservative assumptions, the 10-year calculated IRR turns out to be 23.6%. Obviously, this is a very high number, so I wanted to double check that such return is in line with historical norm. So I calculated more than 10 years of ROIC and ROE of the largest media companies, and applied these averages to WBD's current assets and equity. And because I used several different methods of valuations, I used a football field to show the overall result. The first and most conservative approach, which used recent 2 years COVID-affected lowered earnings, In this case, WBD's intrinsic value per share is calculated to be between $13 and $19 per share. If I use pre-COVID average or even bake in the management's synergy expectations, then value ranges from $24 to $45 per share. Lastly, using the long-term historical average ROE and ROIC, the value remains at a high level as well. And since current WBD price is only about $10 per share, and the stock traded from $9 to $19 in the past 6 months, there seems to be a large margin of safety, at least 100% upside from current price, however you look at the valuation. And looking at this chart, it's not surprising that so many super investors are investing in WBD right now. Alright, that's gonna do it for today's video, and thank you all for watching. I really do appreciate it. If this video benefited you in any way, please click the like button below and also subscribe to the channel. And I will deliver deep dive numerical analysis on companies that are chosen by super investors. Also, feel free to share your thoughts on WBD. Why are you buying it or avoiding it? Please share in the comments. Okay, thanks again. I'll see you in the next media company analysis. Take care.